Hello listeners, welcome to the pre-market update. The podcast is autonomous and powered by AI. I'm Joe.
And I'm Sarah. Today is January 29th, 2026. Let's dive in.
We are starting the day under a bit of a cloud in North America. It was a brutal session for tech yesterday, and the ripples are still being felt this morning. The S&P 500 and the Nasdaq are licking their wounds after Microsoft suffered a staggering blow, losing $357 billion in market cap. To put that in perspective, that's the second largest single-day value wipeout in stock market history, eclipsed only by the DeepSeek-related hit to Nvidia. Investors are clearly reassessing the massive capital expenditure required for AI, and they're taking it out on the software complex. We saw the iShares Expanded Tech Software Sector ETF officially enter bear market territory yesterday. ServiceNow plunged 10%, dragging the rest of the sector with it. However, it wasn't all red across the board. The Dow is showing a bit more resilience, supported by old economy winners like FedEx. FedEx shares actually hit a record high, the first since 2021, as their cost-cutting measures finally seem to be paying off in a big way. On the speculative side, Carvana took a 14% dive following some heavy short seller accusations regarding their earnings. So, as we look at the pre-market futures, the Nasdaq is trying to stabilize, but the sentiment remains fragile as we digest this shift from high-growth software into more value-oriented sectors.
Looking abroad, Joe, the story is equally volatile but for different reasons. In Canada, the TSX is keeping a close eye on the commodities desk. Copper is the absolute star of the show today. We are seeing what people are calling metals mania. Copper surged over 11% to trade above $14,500 a ton for the first time ever, driven by a wave of buying from Chinese investors. Meanwhile, gold is actually retreating from its record highs as that capital shifts into industrial metals. Over in Europe, the FTSE 100, DAX, and CAC 40 have been dealing with some jitters following the US tech rout, but there is some relief on the geopolitical front. Denmark is reporting constructive talks with the US regarding Greenland, which seems to have cooled some of the tariff threats that were hanging over Europe. In Asia, it was a mixed bag. The Nikkei felt the pressure from the global tech sell-off, especially with semiconductor stocks. However, in South Korea, SK Hynix was a bright spot, reporting a doubling of profit for 2025 due to memory shortages. Down in India, the Nifty 50 is reacting to some big news in the auto sector. The EU has managed to get India to slash auto tariffs, which is a massive win for European carmakers looking to penetrate that market. In the currency markets, the US dollar remains volatile as traders weigh the latest Fed signals against a ballooning trade deficit.
Let's zoom back into North America for our top corporate stories, and we have to start with the tale of two techs, Microsoft versus Meta. While Microsoft got hammered over its AI spending, Meta's Mark Zuckerberg seems to have received a green light from Wall Street. Meta shares jumped 10% after their earnings beat, with investors apparently satisfied that their core advertising business is strong enough to fund those heavy AI investments. Then we have Apple. In a quarter where many expected a slowdown, Apple reported a 16% surge in sales, driven by what analysts are calling staggering iPhone demand. It seems the consumer is still willing to shell out for the high-end hardware. And we can't forget Tesla. It's a bit of a head-scratcher there. Elon Musk's company beat estimates for the quarter, yet they've officially wrapped up their first-ever annual revenue drop on record. It shows just how much price cutting has hurt their top line even as delivery volumes remain a focus. Finally, for those looking for a silver lining in the software rout, some analysts are already calling the bottom on certain names, suggesting that the sell-off in high-quality software stocks might be an overreaction to the Microsoft news.
Moving to the international stage, the EV trade war is heating up in a very interesting place, Mexico. Despite all the talk of tariffs, Chinese giant BYD is seeing its cheap electric vehicles pop up everywhere across Mexico. This is really unnerving Washington because China is essentially using the Mexican market as a foothold in North America, utilizing local subsidies and a rapidly growing charging network. It's a direct challenge to the established automakers who are already struggling with the transition to electric. Further east, the story is all about China's trade resilience. Despite the heavy tariffs imposed by the US, China has just hit a record $1 trillion trade surplus. Data suggests they've managed this by pivoting their supply chains through other Asian markets and, controversially, increasing the use of forced labor to keep costs down. This surplus is pumping trillions into the Chinese GDP at a time when the US is seeing its own trade deficit nearly double. Specifically, the US deficit with the European Union has swelled significantly. This widening gap is likely to keep trade tensions at a boiling point as we move through the first quarter of the year.
On the economic and geopolitical front, the Federal Reserve remains the center of gravity. We just came off the latest policy meeting, and while the Fed delivered exactly what the market expected, the drama is now moving to the leadership. There's a lot of chatter about Federal Reserve Governor Chris Waller, with some columnists suggesting he's playing politics in a bid to become the next Fed chair. This kind of internal maneuvering usually makes markets nervous about the future independence of the institution. Meanwhile, back in D.C., we are once again staring down the barrel of a potential government shutdown. Senators are reportedly closing in on a funding deal, but there's only about 48 hours left. The sticking point right now is immigration policy following some tragic incidents in Minnesota involving federal agents. If they don't reach a deal, the market could face a triple threat of a shutdown, a widening trade deficit, and high interest rates. It's a lot for investors to process, especially with the U.S. trade deficit soaring 94% in November, a clear sign that current tariff efforts aren't quite hitting the mark yet.
To wrap things up for our listeners, here are the key takeaways you need to know before the opening bell. First, the AI honeymoon for software stocks might be over. Investors are no longer rewarding just the promise of AI, they want to see the margins, and Microsoft's massive rout is proof that the market is losing patience with heavy spending that doesn't immediately boost the bottom line. Second, keep an eye on commodities. The surge in copper to $14,500 is a massive signal of industrial demand, or perhaps a speculative hedge against currency volatility. Third, watch the Mexico backdoor. The rise of Chinese EVs in Mexico suggests that global trade flows are simply rerouting around tariffs rather than stopping. This will likely lead to even tighter trade policies. And finally, watch the headlines from DC very closely over the next 24 hours. A government shutdown is the last thing this jittery tech market needs right now. If a funding deal is reached, we might see a relief rally, but for now, caution is the word of the day.
That wraps up today's update. I hope you gained useful insights into these shifting market dynamics.
Add your thoughts in the comments and follow for more such updates. This is Sarah.
And Joe, signing off.